In 1980, an ordinary house in America was not just a place to live. For many investors, it was becoming something much bigger, a financial asset, a source of income, and a path toward long-term wealth. Across the United States, millions of people have built financial security through real estate. They bought houses, apartment buildings, commercial properties, and land, then used rental income, property appreciation, and careful financial planning to grow their wealth. But real estate investing is not a magic formula where anyone buys a property and automatically becomes rich. Behind every successful investor is research, patience, risk management, and the ability to understand how money moves through the housing market. So how exactly do American real estate investors build wealth? Why do some investors create portfolios worth millions of dollars, while others lose money on properties that looked like great opportunities? To understand this, we need to look at the foundation of real estate investing. Unlike stocks, cryptocurrencies, or other financial assets, real estate is physical. A house, apartment building, or piece of land exists in the real world. Investors can improve it, rent it, borrow against it, or sell it when conditions are favorable. The first major way investors build wealth is through appreciation. When a property increases in value over time, the owner gains equity. Imagine an investor buys a property for $300,000. Years later, because of neighborhood growth, inflation, improvements, and higher demand, the property value rises to $450,000. The investor now controls an asset that has increased by $150,000. However, appreciation is not guaranteed. Real estate markets move through cycles. Interest rates, economic conditions, job growth, population changes, and housing supply can all influence property values. The second major wealth-building method is rental income. Many investors purchase properties because they want monthly cash flow. Instead of waiting years for a property to increase in value, they generate income immediately by renting it to tenants. A landlord collects rent each month and uses that money to cover expenses such as mortgage payments, property taxes, insurance, repairs, and maintenance. If the rental income is higher than the expenses, the investor creates positive cash flow. Over time, this creates a powerful combination. The investor owns an appreciating asset while also receiving income from it. This is one reason rental properties have attracted generations of American investors. But one of the biggest advantages of real estate comes from a concept called leverage. Leverage means using borrowed money to control a larger asset. For example, instead of paying $400,000 in cash for a property, an investor may put down $80,000 and use a mortgage for the remaining amount. If the property increases in value, the investor benefits from the growth of the entire property. But leverage works both ways. While borrowed money can accelerate growth, it can also increase risk. Higher interest rates, unexpected repairs, vacancies, or falling property values can create serious financial pressure. Successful investors understand that debt is a tool, not a guarantee. One strategy that became popular among many investors is the BRRRR method. BRRRR stands for buy, rehab, rent, refinance, and repeat. The idea is simple. Investors purchase undervalued properties, improve them through renovations, rent them to tenants, refinance based on the improved value, and use the recovered capital to invest in another property. For example, an investor may purchase an old house for $200,000. After spending money on repairs, the property may become worth $300,000. The investor can then refinance and potentially use some of the increased equity for another investment. However, this strategy requires accurate calculations. Renovation costs, financing conditions, and market demand can determine whether the strategy succeeds or fails. Another major strategy used by investors is value-add investing. Instead of buying a perfect property, investors search for opportunities where improvements can increase value. They renovate kitchens, upgrade bathrooms, improve buildings, add new features, or make properties more attractive to tenants. Large real estate companies use similar strategies on a much bigger scale. They purchase apartment complexes, improve operations, increase rental income, and increase the overall value of the property. But real estate wealth is not only about buying properties. It is also about using financial strategies. Many investors use tax planning to protect their profits. For example, rental property owners may benefit from depreciation rules that allow certain property costs to be deducted over time. Another tool used by some investors is the 1031 exchange. Under specific IRS rules, a qualifying investor may exchange one investment property for another similar property and potentially defer recognizing certain gains, instead of paying taxes immediately on the sale. The process has strict requirements and timelines. These strategies show an important difference between professional investors and beginners. Successful investors do not only think about buying and selling, they think about cash flow, taxes, financing, risk, and long-term planning. Another important factor is location. Real estate investors study cities, neighborhoods, employment trends, transportation, schools, and future development. A cheap property in an area with declining population and weak demand may become a difficult investment. Meanwhile, a more expensive property in a growing market with strong employment opportunities may create better long-term results. This is why experienced investors often say that location is one of the most important rules in real estate. But even the best location cannot replace good management. A property requires maintenance, tenant communication, legal compliance, insurance, and financial organization. Many new investors underestimate these responsibilities. They see real estate as passive income, but successful investors often spend significant time analyzing deals, solving problems, and managing their portfolios. Over time, patience becomes one of the biggest advantages. Many successful investors hold properties for years or even decades. They allow tenants to pay down mortgages, property values to grow, and equity to accumulate. This long-term approach has created some of America's largest real estate fortunes. However, history has also shown the risks. During the 2008 financial crisis, millions of Americans experienced the consequences of risky lending and excessive borrowing. Housing prices collapsed in many markets, financial institutions suffered major losses, and many homeowners lost their properties. The crisis proved one important lesson. Real estate is not guaranteed wealth. Poor decisions, too much debt, and ignoring market conditions can create devastating results. Today, investors continue to monitor interest rates, housing supply, affordability, and economic changes. Higher mortgage rates can reduce buyer demand. Limited housing supply can push prices higher in certain markets. Economic growth can create new opportunities. The future of real estate investing is also changing. Technology has made it easier to analyze markets, discover properties, manage rentals, and connect investors. Online platforms have created new ways for people to access real estate opportunities without following traditional methods. At the same time, remote work and changing lifestyles are transforming where Americans choose to live. Some investors are focusing on smaller cities, suburban communities, and emerging markets where demand is increasing. But despite all these changes, the basic principles remain the same. Successful real estate investors understand numbers. They study markets before buying. They calculate risks before borrowing. They create systems instead of depending on luck. The biggest lesson from American real estate investing is that wealth is usually built slowly. A property alone does not create success. Knowledge, discipline, patience, and smart decisions are what turn real estate into a wealth-building tool. For some people, real estate has created financial independence. For others, poor planning has created financial stress. The difference often comes down to preparation. The story of American real estate is not just about houses and buildings. It is about how ordinary assets can become powerful financial tools when combined with strategy and long-term thinking.